You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen. It is the 13th of September, 2022. And in this week's episode, we'll be discussing Halfords, Genus, WHSmith, Barratt Developments, WHSmith, and our US company of the week is Build-A-Bear. John, do you want to start us off with Halfords?
Yes, so Halfords, the FTSE 250 cycle and car parts retailer, which has recently moved into the automotive servicing sector, had a 20-week trading update out last week, with total revenue growing 9.2%, but minus 1.9% on a like-for-like basis, up against strong prior comparatives when sales benefited from the UK emerging from the final COVID-19 lockdown. There's a strong total revenue growth compared with the full year 2020, up 30.3% and 11.7% on a like-for-like basis, with all segments showing like-for-like growth over 3 years, with auto centres up 28.2%, retail motoring up 8.5% and cycling up 9.5%. Strategic acquisitions were the key driver of total sales growth. And if we break the results down a little further, then, as mentioned, the auto centres reported strong revenue growth of 28.2%, with total growth compared with 2022, which also includes acquisitions, was up a total of 67.8%. And auto centres now make up in the region of a third of the group's total sales. Encouragingly, the tyre market share increased. However, the overall market is behind pre-pandemic levels, with hybrid working continuing. In the retail division, trading was up broadly in line with expectations and revenue grew 8.9%. Motoring revenue in store continued to grow market share, with revenue up 8.5%. Cycling also grew revenue, but by 9.5%, with a higher market share partially offsetting the impact of a declining market. Over 500,000 customers are subscribed to the new loyalty club scheme, which launched in March 2022. Going forward, the group expects profits in the second half of the year to exceed the first half, and stock levels are in line with expectations. More than 70% of sales now coming from the motoring and services, which management believe is leading to a very resilient group performance, because these items are needs-based rather than reliant on discretionary spending. Despite this, the group is mindful of rising costs and is progressing with cost savings and inflation mitigation targets, and expect full-year underlying profit to be between 65 and 75 million pounds. I thought this trading update was better than expected. However, as we've talked about before on the show, I'm not sure about the fundamentals of the business, and the group are expecting profits to fall by more than 20% this year. And I would really question how defensive the motoring services business actually is, and also how future-proof it is, given that more and more people are buying electric cars, therefore fewer service items, which, if this is a business that has a future, is more concerning if it's going into that traditional thing. I suppose as well, with inflationary costs and the wage price spiral, that's going to hit the automotive servicing pretty hard. That being said, it is cheap at 5 times forward earnings, especially compared with the 10-year average, and it does have a dividend of 7%. But given where it's going, it would be one I'd be avoiding. Sam, what are your thoughts on this trading statement?
Pretty similar to you. You can't really deny it's cheap, but I think these results standalone are pretty decent. The only thing I'd say, and I said this last time, it's the strategy of the acquisitions for the auto. I don't like it. They could do this in a few years' time. We look back and we say, well, that was genius. They're visionary, but I think it's a very fragmented market for a reason. And I don't know if there's going to be that much benefits to going and hoovering everyone up. I think it's very, very competitive. There's not really anything any unique selling point or any way to stand out. It's very commoditized. And really, the only thing people really focus on is convenience of where you are and your price.
Yeah. And I
So,
suppose
yeah.
they are going after that a bit with this membership loyalty scheme, the discount. But yeah, it's very thin, I would say. And if you did have a small sort of garage business, it might be one that you're looking to sell rather than one where you're wanting to acquire it, really.
Yeah. So
Get out.
yeah, it's a pretty cheap business. I don't think it looks like a terrible business, but it just wouldn't interest me.
No, fine. Okay. On to Barratt, a company you might like a little bit more.
Yes. Well, actually, we'll do Genus, I think.
Sorry, Genus.
Yeah, we'll save Barratt for you. I know you're keen for your house builder. But we've got a debut for the show first. So Genus is an animal genetics company, and the company provides farmers with genetics that enable them to produce animal protein for breeding pigs and cattle in the form of meat and milk. The company operates through 3 segments: Genus PIC, Genus ABS, and Genus R&D. The PIC segment is engaged in porcine sales, which is pigs, and the Genus ABS segment is engaged in bovine sales, which is cows. Its bovine genetics business sells dairy and beef bull semen and embryos from its superior cattle, which are sold to farmers to breed their cows through artificial insemination. Its porcine genetics business sells genetically superior breeding pigs and semen to farmers to breed commercial pigs with desirable characteristics for pork production. The company operates in 25 countries on 6 continents, and they are listed on the FTSE. So they've come out with their full year results, and revenue was up 3% to 593.4 million. Operating profit was up 4% to 49.4 million. Profit before tax was down 13% to 48.4 million. Free cash flow was down 136% from 37.5 million to a 13.5 million outflow. And basic earnings per share was down 14% to 62.5p. They highlighted the challenging market conditions for the PIC business, which is pork in China, but they said that there was strong PIC performance elsewhere. They've said that China pig prices were down 50% on the prior year, but these have now recovered to a level which exceed the cost of production for most producers. Excluding China, PIC volumes were up 8% and revenue up 4%. Royalty revenue was up 8% and adjusted operating profit up 11%. Strong customer wins drove North America growth and solid performances in Latin America and Europe, despite challenging market conditions for customers. Yes, they said there was good performance in ABS, which is bovine, which is cows, with adjusted operating profit growth of 9% and volume growth of 3%, despite more challenging markets for producers. Strong growth in third-party sales of intelligent sexed semen production in North America and Europe. And there was high growth in Asia, particularly China, and continued growth in Latin America. Overall, ABS's adjusted operating profit was up 9%. They said the free cash outflow reflects lower profit from PIC China, continued investment in the business, as well as expected working capital outflows. They've highlighted the solid cash conversion of 82%. Net debt increased to 185 million, with year-end net debt to EBITDA at about 1.7x, which is within the 1 to 2x targeted range. They've said they made further genetic progress in pork, dairy, and beef, contributing to a reduction in use of energy, water, and land in animal protein production. They've made an acquisition in Canada of Olymel LP's internal early porcine genetics program, AlphaGene, for 25 million Canadian dollars in February 2022, and they said that's progressing well and was generating royalties in the second half. And this, I found this a bit weird actually, but in one of the slides they're talking about the industry leading genetics driving market share gains. But they've got this one pig that's used by where the genes are used by 85% of top 20 North American producers, and it's called the PIC 800, which I just found really weird because it's an animal and they're talking about it like it's a Hoover or something. But anyway,
more like a Terminator.
Yes, just not. And then it's just got a picture of a pig next to it. It's just I don't know who came up with that, but it's just a bit weird. But anyway, in terms of valuation, it trades at a PE of 34.92 if you use the adjusted earnings and 44.61 on the actual. Ooh. Yeah, it's not cheap.
And that's come down a lot in the last year.
It has, yeah. In terms of revenue, if you look at the last 5 years, revenue's increased over that period from 470 million to 593. Earnings about where they were 5 years ago. So it's very expensive. I can't immediately see why that is. I don't know if it's partly just because of the industry it's in, just with increasing populations and stuff like that. Maybe.
Yeah.
It is something that's definitely going to have a future, you'd think. But then, yeah, very expensive. And for me, I'd almost view it as akin to a pharmaceutical company. Like, you know, when you're talking about the PIC 800, how am I meant to know what the competitive advantage is for that?
I've seen the pictures.
Yeah, and, you know, the pipeline and stuff like that, it's quite hard to measure. So for me, it just goes in the too hard pile, but interesting business. What are your thoughts, John?
Yeah, I mean, largely the same. Obviously, on the surface of it, it's very expensive, but you can see if it's going down that sort of genetically modified route, how big, if there's wide scale adoption of it, I mean, it could be absolutely massive. So I suppose, that's the justification behind the price, but I'm no expert. And I think it would, probably take many years to be able to fully understand it. Right.
Should we move on to WHSmith?
Yeah, WHSmith, the favourite box maker of the show, and
the official box maker of the Investor Way.
Yeah, there's no official affiliation and no sponsorship. But anyway, FTSE 100 constituents, they had a trading statement out for the first quarter from the 1st of May, with strong growth in profits and returns underpinned by excellent customer relations and continued price recovery, good cost and cash management. Overall trading was in line with expectations, driven by pricing momentum and good cost control. Corrugated box volumes in the quarter declined slightly on a like-for-like basis, as expected, and against growth in the comparative quarter of 13%. They continue to expect growth of at least 2% for the full year. Virtually all input costs, including energy, have increased significantly, and energy cost increases have been substantially mitigated by efficiency initiatives and by long-term hedging. Currently, more than 90% of natural gas costs are hedged for the full year 2023 and around 80% for the full year 2024, with costs being recovered through increased packaging prices. Long-term supplier relationships and other cost management programs are in place to help mitigating ongoing inflationary pressures further. The outlook for full year 23 remains unchanged, with the expectation of a significant improvement in performance with ongoing strong operating cash flow generation. Miles Roberts, the chief executive, has come out and said, "We have started the financial year very strongly, despite the current macroeconomic conditions. Whilst the industrial sector is showing some weakness, our FMCG business remains resilient. The increased profitability and cash generation is being driven by improving efficiency and cost increase mitigation, as well as successfully continuing to raise packaging prices. Overall returns on capital remain within our medium-term target. As we enter the second quarter, we are very mindful of the challenging economic environment in which we operate and the impact it has on both customers and colleagues. However, our operating plans and progress to date continue to give us confidence for our full year outlook for 2023. In terms of valuation, WHSmith trades at 7.4 times forward earnings, and that compares favorably with a 10-year average of around 12. And in the next 12 months, it's expected to yield in the region of 6.5%. I mean, I thought this trading statement was largely a positive one. I guess the big concern, which they've sort of alluded to and explained what they're doing about it, is the input costs, which are going up massively. I guess there's the relief that they will have that with the new government. They have said that they're going to cap, or they're going to have a price freeze for energy costs for businesses for 6 months, and then it looks likely that it might extend. I'm not sure exactly when they did this fixing, because potentially they might be worse off from that. I don't know. I'd have to dig into that further, but they didn't give further detail in the statement itself. It's looking cheap, but there are significant headwinds. I think it's a quality business. We've covered it a lot of times before, and it's got long-term fundamentals in terms of the direction of the business. It's sort of a defensive play on a growth market with growing e-commerce, and that only looks like it's going in one direction. So I'd still say it's my favorite box maker and remains on the watch list. I don't think I'm quite brave enough to pull the trigger on it, and I think there are probably other things that I would prefer. Sam, your thoughts on WHSmith?
Continue to like it. I think it's a very good business. As you say, we don't know whether the hedging's benefited them or not, but at least they've been able to actually plan as a result of it because they've got some certainty of it. So I think 90% hedged for the natural gas for 2023 and 80% the year after. They've obviously done it at a price they're comfortable with, even if they could have done it a bit cheaper later on. I think it's pretty smart planning, to be honest, because they can just crack on with actually running the business. I think it's very cheap.
Certainty, yeah.
Yes. You just pay. It's like if they are paying extra, I guess you're paying for the certainty. But I think they're very cheap, very good dividend. Possibly, well, we discussed it before, but it's possibly a bit of a cyclical business. But as to how it performs in a recession, I don't know. But so far, it's held up very well. Although the share price hasn't, but the business seems to have held up very well. So yeah, I think it's 7.4 times earnings. You can do a lot worse.
Is it one that you'd add to your watch list or actually go ahead and buy?
Probably not. I think it's good enough for the watch list, but I don't. I think there's a lot of other businesses I'd want to own before I got to WHSmith, but I do like it.
Yeah, no, that's fair enough. Okay. Time for a house builder of the week.
Time for a house builder of the week.
Cover so many.
Yeah, so this week it's Barratt Developments. So they have come out with their full year results, and full year revenue rose 9.5% to 5.3 billion, reflecting a 3.9% increase in completions back to pre-pandemic levels and improved average selling prices. This helped offset build cost inflation, meaning underlying pre-tax profit rose 14.7% to 1.1 billion. Looking ahead, Barratt expects house prices to moderate, which together with cost inflation of 9 to 10% means gross margins are expected to dip slightly. Overall, the group said market fundamentals remain strong, reflecting the continued imbalance between housing supply and demand. Total completions rose to 17,908. Of these, 746 were joint ventures. Barratt continues to target total home completion growth of 3 to 5% in the new financial year to between 18,400 and 18,800 homes. The group's private reservation rate was 0.81 homes per outlet per week, up slightly from last year's 0.78. Average selling prices rose to 300,200, up from 288,000. Within that, private selling prices rose 4.7% to 340,800, while affordable prices were up 8.8% to 159,400. Barratt is seeing continued inflationary pressure in its skilled labour supply, as well as broader input costs. The group has pricing agreements in place for 73% of its material requirements up until December 22, which isn't very far away. Barratt generated free cash flow of 387.7 million and had net cash of 405 million once 733.6 million of land creditors are taken into account. In terms of valuation, the business has a prospective dividend yield of 9.9% and trades at a PE ratio of 5.23. Yeah, you like that?
Yeah.
My view is very, very, very cheap. I thought these were very good results. I thought the completions was good as well. What was it? Sorry, with the completions back to pre-pandemic levels. My concern, besides the inflation, which we talk about every week, is for the house builders, is the pricing agreement's only been in place to December 2022. That's not very far away. So yeah, but that's possibly why you're getting it so cheap. John, what are your thoughts?
Yeah, I mean we've covered it before, but like the house builders, Barratt is no exception. I think there was a note out from HSBC, and the analysts were talking about the market, or certainly house prices, pulling back a lot with the rising interest rates. I suppose that's something that would affect Barratt in the short term. Also, if we do have that sort of prolonged recession, but I think that the long-term fundamentals are so strong, the business is in a good state to cope with it. And I think if you take the long-term view on the house builders with the structural imbalance that we have in the UK, most of them look pretty attractive and they're very, very cheap. I have Redrow, but I've owned Taylor Wimpey and Persimmon in the past, and I still like them and continuing to hold. And while that dividend's going, just reinvesting that.
Right. Should we move on to WHSmith? I think it's the debut. I don't remember doing it before.
I think it is. I mean, it used to be a darling of the stock market. It's now, well, over COVID, fallen from favor a lot. It's a retailer, but it's the leading travel news agents, and that's where a lot of the business now is. They had their fourth quarter trading update out. So WHSmith, in their statement, have said, further to the group's trading update on the 15th of June, despite some ongoing disruption, our travel businesses have continued to benefit from the recovery in passenger numbers across all of our key travel markets. As passenger numbers continue to recover, we've delivered strong ATV growth and higher penetration, driven by our ongoing strategy to significantly enhance our ranges and develop our categories such as health and beauty and technology. In the UK, our business is performing strongly, and similarly, North America continues to show good momentum. The rest of the world has been slower to recover, but we're now seeing good growth across all of our markets, with the strongest recovery in Europe and more recently notable improvements in Australia and Asia. We continue to make good progress with our store opening program, and we remain in a strong position to benefit from the significant growth opportunities across the global travel retail market. We have over 130 stores won and yet to open, and there are a number of ongoing tenders across our markets. More recently, we are pleased to have won a further 6 new stores in Brussels Airport and further significant wins in North America, including Salt Lake City and Los Angeles International Airports. These new store wins demonstrate the capability of the business to win new stores across different formats and a range of geographies. In terms of the high street, they commented that their businesses are performing in line with expectations. Sales in the second half were adversely impacted following the previously announced disruption to our online greeting business, Funky Pigeon, which was a cyber attack. In our high street business, we continue to focus on cost efficiencies and return on space. We have identified further significant cost-saving opportunities, most notably through reductions in rent. In terms of the full year results, WHSmith expects the outcome for the year ended 31st of August 2022 to be in line with the upgraded expectations, which followed the third quarter trading update on the 15th of June 2022. To me, it seemed a positive update. I guess it's against, well, what had been a business that we had effectively been destroyed by the pandemic, given the percentage of the revenue that comes from the travel. It's really the travel business that would attract me to the business, in the sense that it's almost got a monopoly at airports for magazines, for some of the sort of technology like headphones, particularly in the UK. Beyond that, I think it's the rest of the business, that the high street is quite an antiquated one. I don't think people are buying magazines or stationery anywhere like the numbers that they used to be. So that side of things, not so keen on, but it really, the value is in the travel. It's certainly historically, it's not expensive at the moment. Earnings are going to be coming back, but it's a big recovery play, which is, as we're seeing through these numbers, it is returning. Again, it's difficult to say, of course, what would happen with further waves of COVID, but it looks like globally, maybe with the exception of China, that living with the disease is the current policy. So you wouldn't expect, or you would hope, that travel shouldn't be impacted directly by that. Although with the staffing, that's another question. It's probably not one for me at the moment, but I can see why people might be buying it as that recovery play. Sam, what are your thoughts on WHSmith?
it doesn't overly interest me. I don't like the retail side. I'm not particularly enticed by the travel side either. I think it's easy to say, oh well, if they win the airports, they've basically got a monopoly, but they've only got a monopoly until it's taken off them. There's no real moat there, and if they're making that much money doing it, at some point someone else is probably going to come along and try and take a slice of it. I didn't realize they own Funky Pigeon. I think that is an interesting business. We have covered Moonpig a couple of times before on the show, although Moonpig's by far the dominant of the two. But I didn't realize they owned that. But yeah, for me, I just wouldn't be interested in it. And I don't actually think there's
fair enough.
I don't think there's much to say about this statement either, because very impressive figures in there, but it's up against very easy comparatives.
Yeah, fair enough. And sorry, it does have earnings. I should say that. I think it returned profit earlier this year.
Oh, so it's got earnings like maybe in the last quarter or something, but not based on last year's results. Okay.
Yeah, that's it.
Right.
American Company of the Week.
Yes, so we have Build-A-Bear this week. So I'm sure it's a business most of us are familiar with. But in case it isn't, Build-A-Bear is a this is from their website, by the way, as you may be able to tell. But Build-A-Bear is a multi-generational global brand focused on its mission to add a little more heart to life, appealing to a wide array of consumer groups who enjoy the personal expression in making their own furry friends to celebrate and commemorate life moments. Nearly 500 interactive brick and mortar retail stores operated through a variety of formats provide guests of all ages a hands-on entertaining experience, which often fosters a lasting and emotional brand connection. The company also offers engaging e-commerce/digital purchasing experience on bdev.com, including its online Bear Builder, the animated Bear Builder 3D workshop, and its age-gated, adult-focused Bear Cave. In addition, extending its brand power beyond retail, Build-A-Bear Entertainment, a subsidiary of Build-A-Bear Workshop, is dedicated to creating engaging content for kids and adults that fulfills the company's mission, while the company also offers products at wholesale in non-plush consumer categories via licensing agreements with leading manufacturers. Their first store opened in 1997, and they now have over 346 corporate managed locations, including 305 in the US and Canada, and 41 in the UK and Ireland. And 61 are operated through the third-party retail model, in which they sell their products on a wholesale basis to other companies that then execute the retail experience. They also have 72 franchise stores operating internationally, and that's as of January 2022. So they have come out with their Q2 results. And first half total revenues were $218.3 million, and all these figures are in dollars. The highest in the first half in the company's history, an increase of 17.1% from 2021, and that includes $100.7 million in the second quarter, which was an increase of 6.3% from the prior year. The board has authorized a new share repurchase program of $50 million following the completion of the previous $25 million repurchase. Now, that is significant because their market cap is tiny. I'll just get it up. $217 million. So that's almost a quarter of the shares outstanding will be repurchased. So if we jump into the results, total revenues were for the quarter $100.7 million, which was up 6% on last year. Net retail sales were $95.9 million, a 5% increase on last year. Consolidated e-commerce demand declined 8.4% compared to 2021, which had the benefit of strong launches of key products as growth in Europe was offset by a decline in North America. Compared to the 2019 quarter, digital demand increased by almost 150%. Commercial and international franchise revenues were $4.8 million, a 41.1% increase compared to last year. Gross profit margin was 49.6% compared to 53.2% last year. They said this was primarily driven by the negative impact of an increase in transportation costs as well as other inflationary pressures, partially offset by leverage of fixed occupancy and warehouse costs and lower promotional activity. And they're hoping for an improvement in gross profit margin in the second half of 2022. Selling, general and admin costs were 42.3 million, which was 42% of total revenues, and that's down from 43.2% of total revenues last year. If we look at the first 6 months of the year as a whole, total revenues, as mentioned earlier, highest in the company's history, up 17.1% from a year ago. And net retail sales, 208.8 million, which is up 15.7% on a year ago. Consolidated e-commerce demand dropped 2.3% compared to 2021, with an increase in Europe offset by a decline in North America, but digital demand is up 180% compared to 2019. Commercial and international franchise revenues were 9.6 million, which was a 62.7% increase compared to 2021. For the stores, they've said they expect to end the fiscal 2022 year with an increase in store locations in North America, inclusive of third-party locations, as it continues to make progress on its previously announced plans to open 20 workshops. Separately, they continue to expect to end the year with a reduction in locations within Europe. Combined across geographies, the company plans to have more total locations at the end of 2022 than 2021, inclusive of third-party ones. And for the outlook, they said they expect total revenues in the range of 440 to 460 million compared to 411 million last year. In terms of the valuation, the company has a market cap of 217 million. It trades at a P ratio of 4.5, but that's on trailing 12 months. So if we go and look at the results, so if we take 2019 calendar year, sales were 336 million, then 338 2020 year, then they dropped to 255 in 2021, but they then jumped to 411 million. I think that's partly helped by the increase in online. I think I struggle to work this out actually, but I think they've been a lockdown beneficiary. And then the earnings are very good presently, but if you look at the last 5 years, diluted earnings per share, last year it was $2.93, and that's on a share price of $14. But if you go back 3 years prior to that, loss of $1.65, 2 cents earnings, and loss of $1.23. So I think that's the reason it's so cheap. It's not expected to be sustained. I don't see where the growth comes from. If they're pulling out of Europe, they're probably pretty saturated in America. I think they're pretty saturated here. So yeah, it's very cheap, but I think it's cheap because the market's telling us these results, or particularly the earnings, aren't expected to be maintained. If it can maintain them, then at 4 times earnings, it's a bit of a steal. But I'm not sure I'd be comfortable making that bet. But possibly the cheapest profitable US company we've covered on the show today. John, what are your thoughts on the results and the company?
Yeah, it's just not a company that I would be interested in, but it's an interesting business nonetheless. I mean, it's certainly very cheap at the moment, but I think it's cheap for a reason. And you'd wonder, pulling out of these markets, whether it's a falling knife that you'd probably be best avoided. I appreciate they're saying the outlook's actually that they're expecting more revenue growth, but I'd be staying away.
Based on what I've seen, I think the best case scenario is that earnings stay where they are.
Yeah,
I don't think there's going to be any growth. If they stay where they are at 4.5 times, a P of 4.5, that you can do very well.
Yeah.
But yeah, and as well, the fact that they're doing buybacks, very, very significant buybacks as well. That's that just tells you that management don't have a better use for the cash. Which they can't put it back into the business. Yeah, so I just wouldn't really want a business where the best case scenario is it just treads water. So of the 6 businesses we've looked at this week, Halfords, Genus, WHSmith, Barratt Developments, WHSmith, and Build a Bear. If you had to buy one, which one would it be?
Ooh, it's a good question. I mean, a lot, as you might expect, the house builder Barratt I do like. If I exclude that, because I often go for a house builder, probably say WHSmith. I think that's looks healthy. Again, strong fundamentals, significantly discounted, and unsure on that sort of near-term decision with the hedging of the energy. But I think it's a quality business actually.
I'd be going for Barratt Developments, I think, but my second would be WHSmith.
Sam, you don't own a house builder at the moment. Would you consider one?
Maybe in 20 years.
Okay.
I
it's
just
more-
don't. I'm not investing for income at the moment. I think if I
Yeah.
was, that 10% dividend yield would be quite attractive. But yeah, I like the long term trends. It's just not exciting enough to me. It's a bit too much of a steady grower for my liking.
Yeah, that's fine.
All right. Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.